If you do nothing other than include women in your solutions, you achieve two things that really matter. One is that as an investor, you get a higher return. But then on the economy side, it's actually estimated that if women had the same access to capital as men, we'd have a 6% increase in GDP. There is no other single factor that could increase growth of our economy in that way.
I know a lot of women who've started women's health companies, for example, and they've had to kind of define and describe the women's health problem that they're trying to solve to like a room full of male VCs. Really hard to do sometimes, right?
We have about 50% of our deals in women-led and managed deals. It's not our number one criteria. It just so happens when you look at the data, that's those thresholds that we've achieved.
Yeah. Veris was one of the first impact-only wealth management firms in the world. We've always been women-led or majority women-owned. A firm that in its core believes that sustainable finance should be core to your offering, and that's all you do.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. The percentage of VC investment into companies with women in leadership and equity positions, and specifically in the startup and private equity world, is terribly low compared to the percentage of VC investment going into companies with men in leadership positions. I'm aware of some of these issues that you've already alluded to. So Sharon, be easy on me today. You never know. I might find out I'm part of the problem, and maybe my wife might agree. But I'm a father of a daughter and a stepfather of my wife's daughter, so I'm obviously very interested in this subject and I want to be an ally. So let's start with an overview of Astia, what your mission is, and what's your theory of change.
Yeah. So I really appreciate the preamble because it helps me. Let's start at the 30,000. Actually, we're going to go up to the 60,000 foot level and go a little bit into the thin air. Yeah. To keep you really uncomfortable, get your heart rate really up. But why this matters. Let's start with the why this matters. So I don't see this as a social raison d'etre. Don't get me wrong. I think there is one. There is absolutely a social case to be made. But I actually see this as a real economic challenge. Once again, I told you I'm an economist in my background. All net new jobs in the last 30 years were created by companies that were venture-backed. Companies like Amazon, Walmart, they actually shed jobs ultimately, right? Once you've hit that level of success, they're job killers rather than job growers. Job growth happens out of the innovation economy. Number two, life's full of great challenges, but it's more now than ever. We have a pandemic, an economic crisis, a climate crisis, feeding a growing population. These are real world really difficult challenges that will be addressed through innovation. The solutions for them might not even exist yet today, but they're addressed through innovation. It is my belief as an economist that by excluding a substantial percentage of the population, and I don't mean just women, I also mean people of color. Interestingly, they're horribly underfunded. Well, if we leave this space of innovation to white men only, and white men specifically of a specific pedigree, Wharton, Harvard, or Stanford, we're not going to get as robust a set of solutions because the problem set will be misdefined, because their own experience won't allow them to push the boundaries of the problem. And there's good research that shows this, that to get to true innovation, my favorite research on this is MIT's Professor Malone's research on inclusive teams and their ability to innovate and how they out-innovate even top performing. If you take super intelligent, homogeneous teams, they are always beaten or outperformed by heterogeneous teams, regardless of intellect. You know, as an economist, this matters because we need real solutions. right? We don't need tinkering at the edges. This is an all hands on deck moment to get to real solutions. So I actually don't see this as a social problem. Equally, I know from abundant research that if you do nothing other than include women in your solutions, you achieve two things that really matter. One is that as an investor, you get a higher return. So just with my investor lens, I want inclusive teams because the returns are higher. But then on the economy side, it's actually estimated that if women have the same access to capital as men, just in this space, I don't mean broadly in the economy, I just mean in the venture economy, we'd have a 6% increase in GDP. There is no other single factor that could increase growth of our economy in that way.
Where does that come from, the statistic?
I used to be on Hillary Clinton's, when she was Secretary of State. I was on her advisory body for entrepreneurship. And they did a phenomenal job of measuring the opportunity and impact to GDP and the potential of women. And that was right out of their commission and their work. Babson has also repeated the study and done a phenomenal job of measuring the opportunity as it relates to this part of the economy. So for me, it's about efficiencies of markets. It's about return on capital. It's all of the stuff that you actually are very comfortable with. I just happen to know that when you overlay gender, especially on this part of the economy, because women are so profoundly underrepresented, the dirty little trick is it's actually really easy. If you did nothing other than gender, you impact all of these other things. The other interesting thing is the UN found that as it relates to ESG goals, the environmental sustainability goals, if you do nothing other than gender, you actually end up addressing all of the other goals. Goal number 7 is gender inclusion. If you have no other goal, if you just do that one, you'll hit your economic targets, you will hit your environmental, your health, your food, you hit all of the other ESG goals. So the context of why Astia for me is not the social one. Don't get me wrong, I'm a woman, I care deeply about that. That's different. My motivations are actually as it relates to the opportunity as an investor. I've been investing for 20 years, and I put my performance up against anyone's in Silicon Valley. And by the way, I've been called arrogant for saying that. I say that with all the humility. I don't create the results; the entrepreneurs do. So I don't want you to perceive that I'm being overly arrogant. I'm just stating the obvious. And then equally to the investor is the economic impact. It's massive. What could be done if we could simply trigger or unleash more venture into companies that included women?
What are the key stats that you cite? I think you've mentioned 2%.
A key statistic in venture capital to understand is, and let's remember, it punches above its weight. So one of the reasons we should care about it is it's a driver of the economy, disproportionate to the amount of capital it deploys. So because you're more comfortable with capital market or private equity numbers, venture numbers may look really small, but they punch well above their weight in impacting the economy. So we should care about them. But number one, venture capital for the 20 years that Astia has existed, between 2 and 3% each year gets invested into women CEOs. And equally deplorable is that between 5 and 7% gets invested into teams that have women anywhere. The rest, 95% of venture capital is invested into all male, predominantly white teams.
So 2 to 3% of capital is invested in startups founded or led by women CEOs.
Women CEOs. I don't know if they founded them, but it's women CEOs.
Okay. And 5 to 7% would be companies that may or may not have a woman CEO, but have women on the leadership team, let's say.
Yeah. Exactly. Yeah. Right. And it's been true for the entire 20 years that Astia has existed. So this is sticky stuff. That's the important piece for you to understand too. At its height, we got up to 10% during the dot-com bubble. And then the second the bust happened, we went right back down. But the 10% was women on the team. Women CEOs has never gotten above 5%.
What is the problem here? What you said, it moved up to 10% and now it's back down.
We should remember that it's bigger than venture, right? And this isn't a venture problem. It just happens to come to a head in venture because of how our economy works. Still today in the US and globally, men and women are in separate business networks. And this is just true. There's no way to deny it. And Scott, you used a word that I'm going to call you out on and challenge you to think about differently. You said that you want to be an ally. I want you to be a business partner. I don't want you to be my ally. I want you to be my business partner. And what I mean by that is I want us to find a way to do a deal together. And that's hard. Yeah. It's really hard. There are a lot of barriers to that. Number one, most business transactions occur in what I'll call fairly intimate business settings. Boardrooms, that's very intimate. Offices, C-suites, that's equally intimate. Then you move it out into a social context, golf courses, interestingly intimate. The reason I call them intimate is because you're really only invited into those rooms. You can't self-nominate into those spaces. You're invited in. Historically, men ran business. And so they occupy those intimate spaces. And to get women into those intimate spaces is quite difficult. Venture capital. So it was founded by some great men and a few women. And those men conducted businesses in these intimate spaces around boardrooms, out for a drink. And it was just more comfortable to invite other men in. Because socially, how do you explain to your wife that you and I are going out for a martini to talk about a deal? It's really difficult, but that's where the deal happens. Mm-hmm. And I'm not advocating that's where a deal should happen. I'm highlighting that's where it happens. It's also why women aren't on boards, because you can't self-nominate yourself onto a board. Where it happens, the board's talking and they're talking about potentially expanding. They're going to hire a firm. They know this buddy, but this buddy is someone that they'll send that buddy into the firm to that buddy. They play golf with him every Saturday. He's really smart. He's also on the board of Apple. He's also on the board of da-da-da-da. Then they're done that. The measures of how you move into that intimate space have to do with who knows you, because they're going to talk about you when you're not in the room. That's a good thing. What they think about you from your experience. Do they understand your experience enough to translate it to someone else? And women tend to have unusual or less like men journeys, right? My own into venture isn't the classic journey. Yeah. So it's harder for them to translate it. And then the third one, we should never underestimate the challenge of men and women doing business purely because of how it affects the home life, especially in private equity and venture, where deals are done in informal spaces. That's the best way I can describe it. It bumps up against social pressures. And we kept hearing this from male VCs. An example of some of the things we heard over our years, and this is without judgment. I think this is just the reality. This is social dynamics. We heard from men, I don't know. I wasn't able to really get to know her, so I don't know that I could trust her numbers. And then you ask why. And normally I'd take her out for a beer, but I didn't want to do that because, then she might think I'm hitting on her, and I didn't want to be hitting on her, so I didn't really get to know her. But investment, especially venture capital, is really personal. You got to trust the person. Trust flows very poorly across gender and race. Building that trust is essential to make the investment happen. The other things we heard is I didn't understand what she was saying. She was presenting this company to me. One of our largest exits, two of them actually, are in the space of women's reproductive health. One is a medical device for diagnosing ovarian cancer. The other one is a medical device for treating of hemorrhaging at childbirth. Yeah. When we took both of those companies up to VCs who are in the medical device space, right? So they know science, they know medical science. Some of the feedback we got was take the fallopian tubes off the slides. That's gross. I'll have to go home and ask my wife if this is a real need because I don't know. Isn't it a niche market because it only serves women? Now, these are all interesting questions, but the most interesting to me was the social construct behind the questions. Wait, you have so few women in your life that you have to ask your wife? She's your reference point for business? But the truth is, yes, most of these men only work with other men. And this isn't about judging those men as individuals. This is the stuff in society. When you start a venture firm, you're putting in your own money, you're pulling in other people's money. It's a very trusted space, and you're going to choose people that make you comfortable. That's people just like you. So venture struggles not because it excludes women. It struggles because of its structure. Its structure reinforces all of the social dynamics that exist broadly out there for men and women in business. But it comes to a head because of how much of it is conducted in these intimate spaces. And it doesn't have governance. Most venture firms don't have board of directors. They don't have what I'll call process requirements. They certainly don't have reporting requirements. When you talk to LPs, GPs rarely provide the reports that certainly publicly traded companies would require, but they have hundreds of millions of dollars and don't have the reporting requirements commensurate with that kind of obligation. That's the fundamental issue. Venture is structured around really intimate spaces, and it's uncomfortable and difficult to bring in people who don't remind you of yourself.
Premise that seems to be coming through here is that they're actually leaving money on the table. How does investing in companies with women in leadership roles or founders, how does it deliver better results to investors?
So I'll give you some examples. One of the current fads in Silicon Valley is the unicorn, right? Mm-hmm. And if you think about the companies that have come out of that fad, I struggle to find their business model. Uber, even LinkedIn, even Amazon, until very late, had to require more venture investment to be sustainable. Right? Think about the hundreds of millions of dollars that went into these unicorns so that they could go public. Okay, that's an interesting business model. I'm investing in companies that don't have access to that same amount of capital. So where do they find capital? Customers. That's going to always deliver a higher return to investors than growing through venture investment. So what's interesting about companies that include women and people of color and diverse perspectives is they tend to have a stronger grounding in customer traction. And it's because I don't know the cause and effect. So I'm an economist. So I'm very cautious about talking about cause and effect. But I will say correlationally that when you put women in the executive suite, along with men, I'm a believer in inclusion, not women only. Oh, the MIT research shows that all women teams outperform. That's a different conversation for a different day. I'm a believer in when you bring all and diverse parties to the table, you get a more robust solution that tends to be more grounded in the market, because that's the market. The market is men, women, people of color. And if you can bring that market understanding into the team, it only makes sense that you would see a stronger resonance with customers. And I'll give you some examples of what that means. So we tend to see seed and Series A investments that already have revenue, pretty substantial revenue. Most venture firms don't expect revenue that early. They are very comfortable knowing that follow-on capital is going to be required. In the case of Envision that exited to Boston Scientific, her total raise for a medical device company was a fraction of what many other medical device companies would raise. Because she had a model that resonated with doctors, very early stage. It resonated with existing patient set that was being unserved. When you build real world solutions, you can grow a business very differently, even if it's a venture-backed business. So I have a portfolio of 64 companies right now. Within it, we only have had 4 failures. So we can tolerate 2x and 3x multiples out of a company because we have fewer failures in the portfolio. Absolute failures are just very rare because our companies that we invest in tend to already have a customer traction. So a worst case is that their multiple may be smaller. But in the best case, we're still going to get the upside of the really large wins as well, because we get the 10x and the 12x, like our Envision and the Lydia Health were.
What is the typical failure rate that you benchmark?
Yes. So most venture firms talk about a 10 and 1. 10 failures and 1 company will make up the whole fund. That's the venture model. What other investing tolerates that kind of failure rate? It's mind-boggling. I don't know where that trend emerged from. And by the way, the consequences are dire if you're not that one. So a venture firm will choose its 10 to 15 companies, and they'll decide pretty early on which is the one, and the others, they almost force a shutdown. And subsequently, they burn through their entrepreneurs, both at the ones they shut down, but then if you're that one, boy, you better scale at a rate consistent with a unicorn, which is not humanly sustainable. It tends to burn through the human capital that exists within the team.
I don't know that we got a true overview. Astia is a VC fund.
So Astia is a nonprofit. That matters because we do more than invest, but we do invest under our nonprofit. And we have 3 investment mechanisms. One is the fund. Another one is a direct investment program called Astia Angels. And then a third is called Astia Edge, which is a friends and family round for Latinx and Black female CEOs. A reason I highlight that we're not a classic venture firm is we do much more work than just invest. But we launch investing because we did an assessment of the market, and venture capital, no matter how many great deals we'd show to them, and no matter how much we proved our track record as an accelerator, they wouldn't invest in the company. So we said, fine, we will. And then what's been great is we have phenomenal returns with that investment activity. But we lead with our values. So we value women as leaders, we value inclusion, and we value investment as our force for change. That's our basis.
So have you moved the dial? You're trying to show that you get a better return by the investments you're doing. You've stated you do, but do other VCs recognize that?
What's been really great about Astia launching investment activity is we've deployed to date just over 30 million. We've been able to pull in and syndicate over 550 million. So we leverage very nicely. And for us, the two measures in the marketplace about how we change the market, we're starting to, is number one, that syndicate number is, to us, it matters as much as how much we've deployed. And then equally, if you now look in the market, you're seeing emerging conversation from men and women about how to ensure that their deal flow has women and people of color in it. And you see funds focused on ensuring they do that, and you see funds being raised in order to address that.
Percentage-wise, have you been able to move this 2 to 3 and 5 to 7% of funds at all or not?
Yeah, that 550 million that we've been able to get invest alongside us comes from a very diverse set of sources of capital. So we've been able to pull family offices and corporates into investing in early stage. So my simple answer is no, we have not seen venture capital itself as an industry move, but we've been able to pull in money from elsewhere. So other parts of the investment market are investing now in venture capital.
You teamed up with Eileen Tangal, who you knew way back during your undergraduate years at MIT, and you both somehow decided to start Black Opal Ventures. So what's the story behind the story?
Scott, you alluded to it. Eileen and I actually met, I think maybe the first week of freshman year when we were undergraduates at MIT. So going back all the way back to those MIT years, in 1993, we were, these newbie freshmen, ended up joining a living group together and became very close friends during our 4 years of undergraduate. Eileen was an electrical engineer. I was a chemical engineer, so both engineering students. And she had more of a traditional career path in technology and venture, worked in the startup world. She was a venture capitalist for the past 20 years. But we had stayed very close friends and confidants throughout our careers. And in 2019, we were actually with a group of our girlfriends from college. So there's a group of about 10 of us. We get together every year. At this point in our lives, we were all sort of at a period in our careers where we were, successful professionals at sort of high levels of our careers. And we were sort of sitting around talking about what would be the next phase of our careers. And Eileen and I actually we started talking more in depth about this and, realized that almost for the first time in my career and her career that we actually were seeing synergies of our world. So Eileen had been a deep tech investor. She actually was an investor and a senior partner at a fund called Incutel, which is the fund that the investor that supports the intelligence community. So you can imagine that much of the investments she did were very highly technical things like, artificial intelligence and monitoring and all sorts of really technical solutions that could help support national security. And what she was finding was actually a lot of the technology that she invested in had applicability into healthcare. But often the founders didn't know how to navigate healthcare. As I said, healthcare is a really hard industry to navigate. And so they were kind of missing out on this very big market opportunity because it was hard to get into it. On the flip side, I was working at this startup and we were just starting to kind of use data to really change the way we did a health insurance model. And so for the first time in my career, I was seeing, this opportunity to really use these massive amounts of data that we were generating in healthcare to actually have products and technologies that were really changing things in the healthcare side. And so we had this aha moment. We said, you know what, let's start, why don't I start helping your companies? You can start telling me what you're seeing on your end so I can apply that to my job. And then lo and behold, that ended up becoming a thesis for Black Opal Ventures. We actually started investing some of our own personal capital together in tech. And the idea was is there something highly technical that we could invest in that had applicability in healthcare and life sciences? In 2021, we actually had an opportunity to pitch to Eli Lilly and to their venture group. They were starting an emerging manager program, and we got a chance to speak with them. Eileen had known the head of ventures for a long time, and he said to us, why don't you guys why don't you make this a real fund? There's a real thesis around what you're doing. You're bringing two different vantage points and experiences to the table. And there's a lot of opportunity in healthcare and life sciences to have technology play a big role in that. We both had jobs at the time. I was the CMO at Bind. Eileen was a senior partner at InQtel. She was actually on her way to go to London, do an assignment in London for InQtel. And we had to kind of make a decision about whether we were going to take this opportunity or not. Now, in retrospect, I realize how rare it is to have an opportunity to have a large corporate anchor investor in a fund. But at the time, I didn't quite realize how unusual that was. And so we took a little bit of time to make a decision about whether we wanted to go for this and really start a fund. And it was, not necessarily quite yet on the roadmap. So I actually ended up resigning from Bind and launching the fund on my own in 2022 when we started investing out of our first vehicle. And Eileen joined 7 months later in September of 22 after she finished her time in London with InQtel. And we've been together ever since then, full time at Black Opal Ventures.
I have to ask, where did the name Black Opal come from?
So the name Black Opal was a little bit of just brainstorming on our end. So one of the things that we wanted to do was we wanted to have the name of a gemstone. We were, a female-led fund. We thought let's be a gem. And so we were trying to think about all sorts of names. As I said, we were together in a living group when we were at MIT, and we had the gem of the living group was the pearl. So we always wore pearls. So we thought, why don't we be the pearl, something with the word pearl in it for our name. Couldn't quite think of a name that was that great with the word pearl. So we kept thinking, and the Black Opal came up for several reasons. It's one of the rarest gems in all of the world. And one of the things in venture capital is you're trying, you see a lot of companies and you see a lot of pitches, and you're trying to find that sort of gem that's hidden among all of these companies that's going to be, the standout, the most, transformative company in the industry. The connotation that, we're looking for these Black opals, these very rare gems in the industry, was something that really appealed to us. The second thing around a Black opal is that it's, if you look at it, it has, from one angle, it just may look like a deep colored stone. But the second you start to move it, you start to see these beautiful, brilliant colors. And we really want to kind of bring that brilliance to the venture capital ecosystem, bring in new voices, new people, and bring in a level of, diversity that we haven't really seen in the industry. And so that connotation that this is a gemstone that has these beautiful hidden colors was something that really excited us about the name. Let's find gemstones. We went through the internet and came to the Black Opal, not really knowing much about it, and then realizing it had all these beautiful connotations with it.
Before we dive deeper, I'd love to get a snapshot of Black Opal today. Maybe start at the beginning with the mission and then go on and give me some of the headlines. I mean, this is an investor podcast, so I want to kind of put bookends around at least what we're talking about, and then we're going to drill down on how you're investing.
Black Opal invests in what we say the collision of healthcare and technology. And so we invest in companies that are either applying or developing highly innovative technology to healthcare and life sciences. And we invest in all the frontier technologies that have applicability in this industry. And that really brings together the two backgrounds of the two founders. So I come from healthcare, Eileen comes from deep tech, and we're really trying to bring together those two worlds. The mission of the fund is to, have significant returns, but have positive impact both on the industry that we invest in and on the venture capital ecosystem. And so that's an important, and I know we're going to talk about some of the initiatives we have at Black Opal, but some of those are really to make sure that we are having positive impact on the world using tech for good.
It seems like your portfolio companies show significantly higher representation across gender and racial diversity than what one would expect from a typical venture capital portfolio. How have you managed to achieve that?
Part of it is, the founders of the firm. We are a female-led, minority-led firm. We probably resonate well with companies and founders that are also, maybe not the most common demographic for a venture-backed founder. I also think that, we look for companies that I think the impact focus does probably bring in a demographic of founder that is thinking about profitability and impact at the same time. As I said, we don't have a quota or a demographic focus for our founders, but I think just because of who we are, we've been able to find amazing founders of all demographics and are really, excited about the things that they're doing.
What barriers do you still see in the VC world when it comes to improving diversity, both at the investor level and in portfolio companies?
I've actually spoken about this at a few different events on, particularly around, we know, for example, that female founders just do not get the same amount of capital that male founders do. There's lots of data on that. And so the question is, why is that the case? I mean, are these companies just not as strong as other companies, or is there something that is happening from a bias or representation perspective that we are just not aware of? I often tell female founders, there is probably some implicit bias in there that is making it harder for you to raise your capital from venture capital. And there's probably things that you just have to be able to recognize, go straight to financials and revenue and, things that that really resonate with venture capitalists, rather than potentially, telling a story that doesn't get to that quick enough. The other is, I think it is in all jobs, and particularly in venture capital, there is a lot that comes from, networking and understanding, who's in your network and how you meet those people. If less than 5% of venture capital dollars are actually allocated to female funders, female venture capitalists, that means that female founders have to get capital from many different, from non-female funders, generally so, right? I know a lot of women who've started women's health companies, for example, and they've had to kind of define and describe the women's health problem that they're trying to solve to a room full of male VCs. Really hard to do sometimes, right? You're starting from scratch to describe what menopause is, right? These are very hard things for a female founder to do, where, if you're in a room with a female VC, they're like, yeah, I got it. Tell me about what you're doing and how much money you're making, right? And so, I think there are some of those challenges that exist where explaining the problem may be hard to do, making the case may be hard to do, and the people across the table are just a different demographic as you.
You've raised one fund, right?
We have, yes.
It was $58 million, if I'm right. And somehow you pulled in heavy hitters like Eli Lilly on the big pharma side and Bank of America and JP Morgan on the financial side. So how did you and Eileen pull that off? Because that's pretty impressive for a first fund with no track record?
So the fund is actually, yes, we're investing out of our first vehicle. The fund is actually $63 million. As you mentioned, we have these amazing institutional investors, Eli Lilly, Bank of America, JP Morgan. We have two fund of funds, Illumin Capital and New Summit Capital, and then, a number of individuals that have come in. We have two health systems also, Atlantic Health System and Henry Ford Health System, who are investors. And I think, it's very hard to raise as an emerging manager. We were a team that came from experienced in our relative industries, but had never run a fund together. And we, didn't have a track record together. Eileen had a track record from her many years in investing, but didn't have a track record together. Couple that with the fact that it was actually one of the hardest times to raise a venture capital fund. This is 2022 when, the world felt like it was falling apart. It was, we were not seeing returns. It was a very hard time to raise a venture capital firm. And I think the thing that I think resonated with our investors were a fewfold, right? The first was the kind of industry focus and this idea that healthcare, there's tremendous opportunity in healthcare and life sciences and lots of opportunity to solve problems in this industry. And that bringing together industry experience with venture capital experience is, a really valuable team dynamic because we can both identify companies and support those companies as they go out and commercialize and grow. The second thing is, we're one of the rare female-led funds in venture capital. Less than 5% of assets under management go to female-led funds. We are a fully female-led fund. And I think there is an interest. I think we were able to tap into investors who had a very specific interest in supporting diverse managers, but also wanted diverse managers that had, a good amount of expertise under their belt. And particularly Eileen having 20 years of venture capital experience, there are not a lot of women who have 20 years of venture capital experience, was, I think a de-risking for some of those programs that were supporting diverse and emerging managers. And so, I think it was an aspect of some of the strategic nature of it, in the strategic investors and in others who had an impact focus both on industry impact, but also on people impact.
Just for reference, what are your target returns?
We're targeting top decile returns. And, it's an interesting time to think about returns because we did not invest during some of the very hyped up bubble particularly in healthcare and digital healthcare in 2021. And 2020, 2021, where we had, really high valuations, lots of money raised. And so, we're targeting top decile returns, but also investing at a time when, in fact, it's more of a buyer's market and it's more of a time when we have reasonable valuations. And so both, we think that the thesis of the fund and the sector focus of the fund gives us very good opportunity to meet those return goals, but also the timing of the fund is also a good time to actually be in venture capital because you're ideally investing, and we are ideally investing at a time when valuations are reasonable and we can start to see those significant upticks as companies start to really commercialize.
How many employees do you have?
So we have 2 employees. So we have a team of 4.
Is everything in New York or is Eileen in California?
Eileen's in California. So we're a bi-coastal team. Eileen is based in California. I'm based in New York. Our 2 team members happen to be based in New York, but that was just out of coincidence. The point of the bi-coastal team is what is very nice about it is it allows us to cover very different areas. So, Eileen can cover the classic Silicon Valley tech ecosystem. She does a lot of investing around what I mentioned, which was frontier technologies. So technologies that are sort of the infrastructure and underlying layer of sort of the future of healthcare and life sciences, whether it's a graph database or an AI infrastructure platform that then can have applicability to healthcare and life sciences. I'm in the New York area where there's a ton happening in digital healthcare, very close to Boston where there's a lot happening in the life sciences world. And then we have venture partners kind of all over the country. So we have a venture partner that's based in Chicago. We have a venture partner that's based in London. So we can see some deals from London and Europe. And so we have coverage through sort of non-full-time employees, but partners with the firm.
So let's get into Black Opal a bit below the surface now, and maybe you could discuss Black Opal's theory of change and the problem or the problems that you are trying to solve?
There's probably three big areas in healthcare, or maybe four actually nowadays. I think there's a fourth one that really plays a big role. When I think about healthcare, and this has been the problems that have existed and the way we frame problems in healthcare for my entire career, and that is cost, quality, and access. So how do we keep control of cost in healthcare? How do we improve access to healthcare? And how do we make sure quality of healthcare is high and strong? And I would say that the other area right now in healthcare that's very interesting and another sort of novel problem is how do we make sure things in healthcare are safe and secure, particularly when we think about data and privacy and all these new frontiers of what's happening in healthcare. There's not one single problem in healthcare that needs to be solved. There's a number of problems in healthcare that need to be solved. They are still very big problems that exist, despite lots of trying to change things, are big problems that still do exist. And, healthcare is a massive industry. So we spend globally, we spend about $15 trillion on healthcare. In the US alone, we spend $4 trillion on healthcare. And in the US in particular, we spend more per capita on healthcare than any of our peers in Europe, who are spending probably, a half to 2/3 of what we spend in the US. As a result, there's a lot of push to try and figure out ways to deliver care more cost effectively, to make that care more available and accessible to people. And then again, to make sure that we are providing the best quality care, whether it's, the best therapeutics or the best diagnostics. These are all things that many of us are trying to work out in healthcare. And as I said, I've been working in this area to try and improve access, quality, and cost my whole career. What excites me about the startup and venture capital ecosystem is just the way companies sort of take a different approach than legacy players. It's very common in healthcare for big companies, big players to say, yeah, it's a problem, but we don't know how to solve that. And we love finding companies that are really finding those problems and solving that.
When I was researching you, I found that you said you support founders who are building, as you put it, a brilliant tomorrow. So let's talk about this idea of building a brilliant tomorrow in healthcare. That's a big vision. And when you look at the healthcare system today, as you just mentioned, and I think I'm right, you're investing primarily in the United States. So we're probably talking here today more about the US healthcare system. It's huge and it's complex and it's so big. I have lived most of my adult life abroad, but I did grow up in America and I lived part of my adult life in America. And I get the feeling that nobody really understands how it all works. And if anyone does, I don't think they're saying how it works because they're usually making money off of it. What does that brilliant tomorrow actually look like to you, and how do we get there?
I have a very simple definition of how I hope and envision healthcare to be, and agree with you, Scott. It is a big behemoth of an industry. It has so many players, and on the ground when you're seeking out healthcare or healthcare services, it is like a massively daunting, messy process most of the time. But, when I think about and again, having been in this industry, you're right, it's a messy process, but I'm very, I really do believe that healthcare is improving and changing, even if it does happen at a very slow pace. My dream is that we get the right care to the right patient at the right time, at an affordable cost, right? And if we can start to do that in ways that make it easy for patients, that is a vision of healthcare that I would love to see. And we do some of that, like that happens in certain situations and certain circumstances, but we have so much more to do. We have, diseases that are untreatable. In this day and age, we should be, we are discovering new ways to treat disease that never were treated before. Things like sickle cell anemia, that we had the first gene editing this year for a condition that we had no way to treat the underlying genetic condition like sickle cell anemia. So this idea that we're developing therapeutics, for example, that can treat patients that we never were able to treat before. We have things in healthcare that are using artificial intelligence to try and help patients navigate their care so they actually don't find it to be so daunting and inaccessible and difficult to navigate, but we don't have to pay, tons and tons of humans to do that kind of navigation, which can be, frankly, really costly for any kind of organization in healthcare. And so this idea of technology really changing things and helping us think about a future of healthcare is something that really excites me. And in that simple way of how do we get the right care to the right patient at the right time and make it affordable?
Simple is good. We can use that. You've described your investment thesis as focusing on the collision of healthcare and technology. So tell me, why does investing in this intersection between healthcare and technology represent for tech innovation versus just investing in a traditional tech-focused VC fund? What opportunities are you seeing there that others might be missing by going into a general tech VC fund?
So, many tech VCs have investments in healthcare and life sciences. I think it is typically part of a portfolio if someone is investing in tech. One of the things that we really focus on is both discerning the kinds of investments that we think are going to do well in this industry, whether it is, as I said, investments that are more of the infrastructure of classic tech that we think have applicability into healthcare and life sciences, or companies that are really purely focusing and playing in the healthcare ecosystem. And the second is really so discerning and understanding the industry to understand where there's problems, where there's gaps, and how these companies can fill the gaps. It takes, there is a level of pattern recognition that happens in any job, particularly in venture capital. And so if you can quickly understand that this is a unique opportunity that this company is tackling, and we know it's going to grow and fill a problem that exists in healthcare, those are the kinds of companies that we are investing in. The second is the value that we help founders with. And as you said, healthcare is one of the most complex, you said nobody really understands it, right? It's one of the most complex industries in the world. And yet it is one of the biggest industries in the world, right? It is 20% of our GDP in the US. As I said, trillions and trillions of dollars spent on healthcare, and hugely impactful for patients and their families. And so we work to really help bring value to our companies, to help them really understand how they commercialize, how you navigate this behemoth of an industry, how you define value for your customers, and how you develop product that is not just tech for the sake of tech, but really tech that is transformative and will be adopted by the industry. And so that specialized expertise that we bring is, I think, that it helps us both identify the best investments, but also bring real value to the table once we have invested in companies.
One of your main problems you identified when we were discussing your theory of change was access. And there's often a perception that improving healthcare access and making it more equitable has to come at the expense of profitability. But you're a VC, you're going after market rate returns. So you're clearly finding investable opportunities in this space. So how do you identify companies that can both make a meaningful impact at the same time generating competitive market rate returns?
So I actually don't think of access as being something that is at the whim of profitability. One of the things that I think about is if we have an access problem, that means there is more market opportunity that exists right now where needs are not getting met. And so access doesn't need to mean that we are providing free care or care at a significantly lower cost. It's that we're providing care for a group of patients or a market that's just not getting the things that they need. And I'll give you a few examples. So we have an investment in a company that is in the obesity management space. So it's a virtual care company called Flight Health. And Flight Health was founded in 2020 by a group of physicians who were practicing at one of the preeminent obesity management clinics in New York City at Cornell. They were sort of one of the founders of the company was actually the founder of the Society of Obesity Medicine 30 years ago, had been talking about this field for years and years, and had been practicing in this area. And that what they found was actually that they were providing this high quality, highly impactful care, but their waiting list was a year long to get an appointment to see them. And what they were able to do was start a company that provided this care virtually, that provided this care with augmented technology to help patients do a lot of self-management, and to use providers that could be guided by experts, but were lower cost providers. And you think about the market opportunity for obesity medicine, it's 50% of the US population is potentially eligible for this kind of care, and only 2% of those patients are actually getting the evidence-based care that they need. That is a massive market opportunity. That doesn't mean that you're necessarily providing that care for free or very low cost, but you're providing high quality, high value care for a very big population. So that's an example where access was a real problem. This company there's still a big market opportunity, but this company is starting to democratize that access in a very high quality way. Another example is a company that we have called Hyro, which is a conversational AI platform that allows patients to call in or use a chatbot to help them find the right provider for them, to help them navigate the care so that they can get in and get appointments and see the right providers for them. That's an area where they're improving access by helping people actually find care, right? Find where there might be appointments available, who might be a good match for them, what's the best kind of care that they may want to seek out. And that's all driven by technology, and particularly by artificial intelligence. And so all these ways that technology is improving access, for example, doesn't mean that it's not profitable businesses, highly profitable businesses, very big market opportunities, also very impactful on that patient and that provider.
But isn't another one of your main points unsustainable cost? It seems like access has a relationship with cost.
It is sort of this triangle, right? If you think about access, quality, and cost, is there a way to find a perfect equilibrium where you're actually providing accessible, high quality care at lower cost? That has been like the holy grail in healthcare for my whole career. We are already seeing technology playing a big role in helping to create that equilibrium of those three. If you can, again, going back to that example of Hyro, if you can get patients to navigate to the right care, you can actually lower the cost of care because they're not doing, ending up in unnecessary places or with unnecessary care. They're actually finding the right care and then getting the right care, as I said, going back to that mantra, getting the right care to the right patient at the right time. You can then improve access and lower cost.
One thing that stands out to me about your approach is how you've integrated diversity into your core thesis. And it doesn't seem to be just a nice to have, but it's a crucial tool for success. So what I'd like to know is, what is the connection you see between diversity and finding better and faster solutions to healthcare problems?
Yeah, so I think in healthcare in particular, the value of having different viewpoints is so critical. I think about, for example, companies where, perhaps an entire leadership team or board may not have diverse backgrounds or demographics or vantage points. And you can get very pigeonholed, I think, into thinking about things in a very narrow way. And so again, we think about how these companies, diverse viewpoints, both at the management team, at the board level, really help these companies be more creative, be more nimble, and think about potentially the end customer, which, at the end of the day is often the patient, in a much more thoughtful way. As I said, we don't have a mandate or a percentage or anything around the types of founders we invest in. But one of the things that we do like to do is help them, I think for the first time, often may not hear this from other venture capitalists, but like, how can we help you round out a management team or build a board that has diverse viewpoints so that you're getting all the best information and all the best resources and building the best products for the patient, for the provider, for the industry, because you have all those people around the table.
Can you talk about how you've seen healthcare access disparities play out in your medical career, and how does that influence your investment decisions now?
I've seen lots of issues in access to care throughout my career. Earlier when we were talking, I told you about, the times where in the early 2000s, I had, all these uninsured patients that didn't have any access to any health insurance, couldn't access any care. We've come a long way from that because of policies in the US. Obviously, in other countries in Europe and the UK, there's single payer systems. They function in very different ways than the US healthcare system. But, this idea of a patient not being able to afford something and that may be life-saving or life-altering for them is, a real tragedy in healthcare. And so when I look at companies, I think, again, if we can find ways to get people covered better in terms of the kind of insurance they have, if we can lower the cost of care, all of those things can really, and if we can get better technology and tools to be able to do so, all of those things, I really believe can be improve access, improve equity, and still be very profitable revenue generating companies.
But how do you see technology helping to bridge these access gaps?
Lots of ways, right? I think, again, we have a lot of things in healthcare that are human driven. Healthcare, if you go back, decades, healthcare was, a doctor and a patient sitting in a room, writing notes, making a decision, maybe getting paid by the insurance company. So many things have from a technology standpoint have changed that, right? For example, electronic health records. As I said, I didn't have electronic health records when I started practicing. Electronic health records have transformed our ability to understand holistically what's happening with a patient. We can see what happened when they saw a different doctor. We can see their lab work that happened a year ago. All these things that have really transformed how we care for patients, all technology driven. Now we're in an age where AI is really taking over a lot of that, right? And in fact, the idea of AI helping a patient find the right care, or AI helping a patient get a diagnosis at home rather than having to go to the doctor's office, all ways that we're improving access to care, lowering cost of care. And the real underpinning of that is technology.
Maybe you could start with a high-level overview of EcoEnterprises and what it's doing, what the mission is, but maybe at the 10,000-meter level for right now, just to frame everything else and provide context for what you'll be speaking about today.
Sure. So essentially, EcoEnterprises Fund is a venture fund for nature. That's the tagline that we've been using for the over 20 years. We act similar to a venture fund. So we're a small, nimble, boutique group that focuses on nature positive and social impact ventures in Latin America. And that's what we invest in. So myself, what do? I oversee the team, CEO, managing partner. I'm a majority owner of the GP and the fund manager. And I have a partner who also has been working with me since the get-go of EcoEnterprises Fund when we were under the umbrella of the Nature Conservancy. And what we do is we manage a portfolio, as any private equity group does as well. And so for Latin America, we're extremely unique and innovative because what we do is we tailor our investments to align with the company's business strategy. So we provide mezz financing or debt financing or quasi-equity or equity financing, depending what the company needs, as well as provide high touch. And so the high touch private equity or venture focus in the U.S. is in a lot of times ordinary course of business. It's not in Latin America. There's really continues to be a void in the marketplace. And so we get very intimately involved in the companies as well as provide that investment capital. And that is what I do day to day. So we manage our stakeholders, our governing bodies, our portfolios, and we undertake investments. And so that's it in a nutshell. Although, of course, there's a lot of details associated with that pursuit.
Is it one fund?
Since we launched our first fund in 2000, we have managed 3 funds. Fund 2 is in wind down, and Fund 3 is in its investment period.
The big picture is they're serial funds. It's
correct.
Funds. To make sure I've got it right, it's a all-woman investment team. I mean, your team is all women, but your investments don't go only into women only, or is the majority women-run companies, or do they?
No. So our team has one male on it, John McKenna. And I mean, you could see on our website who's on the team, because we also have an investment committee and we have an impact committee that's quite diverse. But, the GP and the fund manager are owned by women. But as to our fund per se, we have a challenge. We're part of a program or a initiative that's called the 2X Challenge, which you may be familiar with. And so all of our deals are actually 2X Challenge deals, but we have about 50% of our deals in women-led and managed deals. It's not our number one criteria, because we look for returns and environmental and social impacts. But it just so happens when you look at the data, that's those thresholds that we've achieved.
Yeah. Can you explain the 2X challenge briefly?
Yeah, so the 2X challenge was established, I think, by development finance institutions, and you could check out their website. The goal was to get as much investment capital and other financial resources to push for gender equality and push for women and girls across various different programmatic approaches and in society. And they have different criteria on the investment side as to thresholds to reach. For us, on the investment side, we look at how many women are involved in the companies, what's the percentage of ownership, et cetera, which I just relayed.
You're a woman-run fund, although that's not like really your gender focus or anything like that. How does that play into your zeitgeist, so to speak? I mean, why is that a competitive? You almost talk about like it's a competitive advantage.
Well, I think increasingly investors are interested in focusing on a pledge for social equality, for social justice, having women more involved at a investment level as well as a company level. And we realize that since the get-go, we've always made that sort of part of our fabric or part of our operating philosophy, but haven't really elevated that to expressing it. And so I feel like that's important to raise awareness, to be aligned with our investor interest, and to help change how the whole sustainable investing industry will evolve. Because if you make women front and center or elevate that type of returns, and now as the whole gender lens, gender smart investing, funds focused on women only, all of those are important. But for us, not only the women, because a lot of the small producers are women, a lot of the employees are women, a lot of the executive team is women, especially on the operations side. But, for us, and we talked about this yesterday, a lot of it has to do with local communities, indigenous peoples, all of that. And so now we're just making it part of our communication.
And how did you focus on Latin America? How did you come up with that as an exclusive focus for the fund?
Yeah, so as an outgrowth of the Nature Conservancy, our history is based on what some of the needs were in 1996, 1997, 1998, when the Nature Conservancy was doing its work. The Nature Conservancy is one of the largest global environmental conservation organizations, and it's been around for many years, and it's extremely innovative. It comes up with differing tools, conservation tools, to address the need to preserve and conserve ecosystems and lands. And at that time, when we were launched, the Nature Conservancy realized that it must work with local communities in which it worked to come up with sustainable livelihoods, to combine the land preservation and protection with working with local communities on the sustainability of the natural resource base. And so a business development enterprise as well as investment emerged as a strategy. And still to this day, about 40 or 45% of all biodiversity on the planet really is in Latin America. One of the main drivers of the EcoEnterprises Fund strategy was to work with local institutional players like NGOs, environmental organizations, nature conservancy partners in country to come up with ways to use investment as a tool in the region. And so I joined the Nature Conservancy with the focus of Latin America. And then when we spun off from the Conservancy, we did some legwork because we had investors that came to us and said, well, you're doing an amazing job coming up with these portfolios in Latin America. How about expanding into other regions? And we did due diligence and investigation to try to look at whether or not we could add value in the same regard in other regions. And we decided it was better to deepen and expand upon our work in Latin America rather than go elsewhere. So that's why we continue to work in Latin America.
And what is your AUM?
So currently we have two funds under management, and both of them are together combined about $150 million.
And I presume that's been increasing over the years from fund to fund.
Correct.
Like what fund one?
Fund one was quite interesting because as we launched in 2000, and in 2000, much different scene than today, right? So this is pre-organic agriculture, pre-impact investing, pre-everything. And so at that time, we were a blended value instrument. And so there's a lot of growth in blended value instruments in the impact space now. But at that time, we combined an investment pool, investment capital with technical assistance monies, because we had to create a proof of concept. And so at that time, we had $6 million in capital and about $12 million in other monies to support the startups of these deals and our operation. The combined instrument was 10 million. So it was 6 and 4.
Tell me, what does nature-based mean and why natural capital is important or should be important to investors?
You mentioned earlier that a lot of our businesses seem to be agriculture oriented or sustainable agriculture, or you said food oriented. And when you look at economic activity in Latin America, most of the population is in rural communities. Most of the economic activity is agriculture based. So no doubt then our portfolio, when you look at the allocations, are really agri-based across the whole value chain. Well, what we consider as nature, we have forestry, agroforestry, we have aquaculture, we have agriculture, and then also we include ecotourism and also emerging opportunities, which have a tie into natural resources. And so natural resources are critical to the globally, of course, because we're all now recognizing the tie between climate and biodiversity and planetary health. and of course are very much tied to local communities and rural communities and populations. And so that's why when we look at deals and when we invest in companies, we want to see that the companies are in collaboration or have working partnerships with the local communities, that there is a vested interest among all stakeholders for the long-term sustainability of that natural resource. And that's why, in my mind, you see the emergence of the whole natural capital conversation. And so the concept of natural capital, the concept of the planet as an asset and a natural asset has been around for some time, although now it's much more in the mainstream thinking. But certainly players like EcoEnterprises Fund, and we've been around for a very long time, that's been our underlying investment thesis and really the value that we bring to our investors and what we've been focused on for all these years.
You stated that the economic needs of rural communities are inextricably linked with successful conservation. I suppose if you have to feed your family or protect forests, you're going to feed your family. Can you explain why this is important and how it plays out with the kind of investments you make, how that keeps that linkage in mind?
So most of the companies that we work with work in areas, either grow its product, sell its product, work within places that have a natural habitat, that has a local habitat. And so going back to why this is important is because, as you said, families need to feed themselves. You need to focus on the health and well-being of local communities. So when companies move into these areas to grow product, to plant trees, so we have companies that have moved into areas and replanted, deforested cattle lands with citrus, like organic lime trees. So in those cases, so what you want to make sure is that the companies have a vested interest in the actual operations as employees, as small producers, as small farmers that actually also could sell product into the company. So it's like a fully sustainable unit, so that there doesn't continue to be slash and burn agriculture, or there doesn't continue to be over harvesting of a particular crop, which then forces communities to move elsewhere. I mean, you're talking about rural peoples, you're talking about indigenous peoples that are in these locations. And so that's why you have to look at it on a holistic basis. And if you see Sambason, that's been working for 20 years. A lot of the other companies that we have been working with have been there for years. It's those partnerships that pay off, not only for the long-term investment prospects that we see in these companies, is the growth of the communities are really tied to the growth of these businesses. And that then, of course, for us to invest, we look for those leaders or those entrepreneurs or those business owners that are aligned with our thinking. Because if they just go into regions and just extract, then you don't have that long-term perspective that we're looking for as well.
What do you look for to ensure that the linkage is actually there?
Yeah, each company and each business model has a different type of relationship with local communities. And so in some cases, the company buys product from those local producers, from those cooperatives, from those local communities. In a lot of those cases, when they buy the product, then the companies also provide technical assistance. So they support the companies, or they support the farmers, or they support the communities with certification, or, fair trade, or health services, or water, or schools. There's some type of relationship established buying and selling product. There are other ways that the communities are also engaged in the companies. We've had companies that work with local communities, and the community has an equity investment in the company. We have communities that have local organizations, and they do the monitoring and evaluation of those companies. We have companies that support local community ventures. There's not one template, nor is there one approach. There's memos of understanding. There's partnership agreements. There are contracts. There are various different mechanisms to really formalize those relationships that the companies have with the producers, the smallholder farmers, the communities, the cooperatives, whichever way you're looking at it, depending on the company.
For the community to benefit in the long term, that would assume somehow an equitable value chain in the supply chain. Most businesses claim to have that. What's the reality that you find?
So what we do look for are certification regimes that have external consultants, external bodies that evaluate the companies. So we do look at companies that have fair trade certification, or we do go in when we do our own, because we have our own impact monitoring and evaluation approaches. And so when we go in, we talk with the local communities. We talk with local NGOs. We ensure that there is that equitable partnering. And if there's not, then certainly we try to improve it. But prior to any investment that we have done, we make sure that we do that rigorous due diligence that ensures that what you see is what you get. And so we're very much aware of the strengths and weaknesses across the board. In many of the deals that we do, in the legal agreements, in our legal investment agreements, we put thresholds, we put milestones, we have an environmental and social action plan within the agreements to ensure that the company's upping their game, as well as certain base requirements that we want in the deal are there.
How big is your team?
There's 7 of us, and we do, though, have a vast network in the region that we rely on.
And these third-party certifications, I guess my question is, you say you do due diligence. How do you ensure that all of this is credible? Because I think supply chain is famously not transparent, not just in Latin America, I mean everywhere.
Yeah, well, I think that increasingly it is. It's becoming, because transparency and tracking, traceability is critical. I mean, you live in Europe, so you know that there are increased regulations and protocols to ensure that each company knows where all their ingredient supplies are. And so in Fund 3, for instance, we've partnered with a group called the Union for Ethical Biotrade that's in the Netherlands, and they actually have been a very strong proponent towards this traceability and being able to track all ingredients. And so as companies scale and as the sophistication of the value chain becomes such, there are many more buying parties. So not only do you have fair trade or you have organic, you have different companies, whether, if they're selling into Whole Foods, for instance, or selling into a retail chain. Even those entities now have certifying agencies. So this is beyond the ISO, or it's beyond the BAP or Global GAP. I mean, increasingly, these companies have certification staff. I mean, when we started EcoEnterprises Fund, you did not have environmental and social management plans or systems at company levels or in-house talent and professionals that focus on that, but now they do. Whether it's if they sell into an export market or sell into a local market, all of those paperwork and management and administration and operations need to be on the up and up in order to sell product into the market. And so that's a very positive trajectory that we're seeing within the market for a lot of our companies.
You do debt, you do equity, you do mezz. You're not restricted in any way about the type of investments. Do you have a preferred structure or not really?
Our preferred structure is really some quasi-equity piece in which we could get upside, but really retain the ability to get current income, as well as if we do some type of equity piece to get a put or an exit because we need liquidation. So we really look for some type of structured exit mechanism in order to get our money out. So that we've learned that we don't do pure equity in Latin America. Just because of the stage, the type of businesses, the exit, cashing out and distributing our returns and capital back to our investors is a priority.
What do you benchmark against?
Well, what we benchmark against is market rates that people are getting on their investments. I mean, we appeal to and attract specific investors that are looking to diversify their portfolio and align their investment objectives with their values, with the sustainability mandate.
What kind of returns have you gotten on your past funds?
What we've made market returns. So Fund 2, let me just say, is winding down, but we're hoping to achieve a 6% to 7% gross on the overall portfolio. So that's for our Fund 2 and Fund 3, where the trajectory is higher than that.
Are your funds open or closed-ended?
They're closed-ended. They're 10 years, 5-year investment, 5-year out.
And typically, what is your exit strategy?
The way that we structure them, most of them just pay out. Most of them are debt-based or debt-like instruments, or instruments that have put options that get paid out over time, or instruments that have royalty payments. So we get cash within that 5 to 10 year period, which ultimately goes back to the investors.
Let's talk about your current role and the move you made to becoming the CEO of Veris Wealth Partners. Tell me, how did that opportunity emerge? And what about Veris resonated with you personally? Was there any particular aspect of their approach that made you think, I need to be a part of this and I need to do it now?
There were a lot of things happening in my life at the time when I was at Tiedemann. My mother got sick and then passed away. So I took a break. I honestly didn't know what I was going to do next. And I recommend that to our listeners. Sometimes it's good to be lost, to just kind of take a break and talk to everyone in your network, or even just look at the clouds and read a good book. What I was sure of is that I'm very mission driven. I have all these different, aspirations around impact investing. A lot of the work around democratization, I still find fascinating. But the learning was I need to be in a fully mission aligned firm. And Tiedemann and a lot of my colleagues in the industry who are wonderful, they work within hybrid structures. So basically or even the big banks like a Goldman or UBS, they have an impact offering, but they themselves are not an impact firm. They're not a B Corp. They have their bread and butter offering, and then they have an impact offering for those who want. And that's a very different thing than having a firm that in its core believes that sustainable finance, the climate transition, racial and gender equity investing, all of those things should be core to your offering. And that's all you do. And so I looked around who in the investment space, I looked at both asset management and wealth management could be a home for me, which is really holistically dedicated to impact. And Veris has been since 2007. It was one of the first impact only wealth management firms in the world, not just in the United States. And I knew there was a succession plan in the works, and the partners of Veris were very thoughtful. They basically planned succession, 2 to 3 years, well, actually a decade in advance, but the execution of it, like hiring the next person, is usually 2 to 3 years in advance. Anyway, so that's where I ended up finding a role as COO, which was not exactly playing to my strengths, but really I was a succession hire, and I've been there almost 6 years now.
What brings someone to Veris instead of a traditional wealth manager? And is there a common thread in their stories or in their values or maybe in their aspirations? What are they seeking that they can't find elsewhere?
I would say it's the impact, the holistic impact approach. And also it's rare to have, a financial institution where the CEO is a woman, and we've always been women led or majority women owned. They want the authenticity of a firm that doesn't just do impact investing, but it self operates as an impact investment. So meaning that we apply our own due diligence lens around impact, around diversity, around equity, around climate. We ourselves are net zero. We ourselves are a B Corp. So most wealth management firms are not. Actually, 98, there are very few firms in our industry who are B Corps. So they want to be aligned with a firm that serves them, that has the same mission and also does policy advocacy, et cetera. So it's alignment, I guess, is really the thing. And they feel, because we're an independent, the other thing, but this hasn't to do so much with impact. We're an open architecture firm, so we don't push our own products. And most of our competitors absolutely do. They have their own investment funds that they push. So even if you fire the advisor, you're still a client of the fund for years to come. You can't unwind right away. We avoid conflicts of interest as much as possible so we can fire or hire managers. If you go, especially with the big bank, you are definitely at the mercy of their own products, which they have an incentive to push.
If we were to fast forward 20 years and Veris has been wildly successful, how would the world be different as a result?
Unfortunately, we have to get into politics here because I'm also the chair of USIF, Investment Forum. The market for us, what would be success beyond just Veris, because we do think of the entirety of the industry, is that the regulatory environment would be friendly to climate investors. So much greater disclosure requirements. So European type requirements on American companies, and also incentives to reduce carbon intensity and carbon emissions. That would already be an extraordinary success if that became the norm of any company. You have to track your carbon footprint and you have to have a net zero goal by, 2050 or you said in 20 years. That would be incredible. But we're in a world where the opposite is happening. There's incredible deregulation, and in Europe as well as in the United States, and the US is far worse, where even the concept of climate is seen as a hoax, a happenstance, not man-made, not proven, et cetera. So we're headed towards greater human strife and environmental disaster. So I think that would be the core thing, we'd be in a world where climate is considered an existential risk and the regulatory bodies take it seriously for what it is. That would be huge.
You're only working within the US?
Yes. For now, we just serve clients whose assets are domiciled in the United States. Yes.
But do you make investments abroad?
Absolutely. Yeah, we do.
Let's step back a minute and just discuss, how does impact investing manifest differently in wealth management compared to other areas of financial services who do impact investing, say, institutional investors or venture capital? And are there unique challenges or opportunities that come with the wealth management context?
That's an excellent question, because I think there are similarities in terms of impact management and measurement, whether it's in asset management or if you work within a foundation, a family office. If you're a professional in banking is, I think, where we're lagging. There's not really an investment banking world in impact. The due diligence mechanism, the approach to measuring outcomes is more or less the same between asset managers and wealth managers. Where I do think it's different is that you're dealing with the total portfolio approach in wealth management. So it's harder because you're not just trying to measure impact in one sub-asset class. You're trying to measure impact across all asset classes. So you can't really add apples and oranges, sort of. I'm trying to simplify it, but the outcome of investing in affordable housing, for real assets, or a venture capital firm where it's number of jobs created, or in public markets where you're looking at carbon intensity per dollar of revenue. Like these are not things you add up. You can possibly add up. You can use UN SDGs to thematically say, here's dollar exposure to number whatever, in the oceans. But it's very hard in wealth management to aggregate impact. It truly is, I think, an Achilles heel versus in other sectors like writ large in asset management. The other difference is, this is true of any B Corp. You need to embed the DEI, the climate, and so on in everything that you do. And in wealth management, it means also in your due diligence of managers. So, and I know this goes against a lot of the executive orders of our president currently, but when you're a wealth manager who select you, so in our case, we don't pick stocks and bonds. We try to hire best in class managers across asset classes. You also have to apply, in our case, we do a DEI lens, a diversity, equity, and inclusion lens to each of the underlying managers so that when you build a portfolio, you're not just saying, well, the underlying investments, have beneficiaries or end users who are diverse, but also the people you invest in these different strategies are diverse, or at least they seek diversity, and they themselves have due diligence in their investment process. I would say in the due diligence and how you conduct business, but also on the back end on the impact reporting, it is slightly different than your traditional, than I would say on the asset manager side. But in impact, we still don't have impact investing in all sectors of finance. So God only knows what that's going to look like in the future. When, for example, we don't have CPAs. The accounting world is not yet in the world of impact. The impact measurement is voluntary and done in-house by investment professionals. There's no auditing. So what does that look like in the future? I don't exactly know. There's also a lot of unknowns because a lot of the financial industry is still nascent to the world of impact.
What type of assets are you investing in?
So in all asset classes, except we don't touch crypto, we don't do commodities. We have, public equities, large cap, small cap, and, global exposure, fixed income, munis, private equity, venture, et cetera.
Are you doing direct investments and investing in funds?
Mostly funds, but sometimes at the client request, we do direct investing as well.
So paint a picture for us of Veris today. For looking at the numbers and scope, the geographic reach, the team composition, what does that look like? And more importantly, what's the secret sauce that distinguishes Veris from other wealth management firms?
So, we're still boutique. We're in high growth mode, but we only manage about 2.3 something. It depends on the day, of course, because it has to do with, markets, but about $2.3 billion under management. There's about 300 clients, and we're moving more and more to institutional clients. So larger and larger clients that are foundations or large endowments. The secret sauce, I think, is the fact that it's 100% focused on impact. And so you have deep expertise around thematic investing, depending on the advisor. Different advisors have different expertise, some around gender lens investing, some around racial and gender equity, some around sustainable food systems. It really runs the gamut. And a lot of our competitors, they invest in oil and gas and they divest from oil and gas. So, a lot of what we do is there's no cognitive dissonance. So that appeals to a lot of clients, especially since we got reelected. There's a lot of, we lost the vote. How do we use financial capital as political capital around climate and around social justice? I would say it's our holistic approach that is our secret sauce and the deep thematic expertise. But we are small. And so, we're all eager to grow faster. And so the issue is how do we grow to have greater impact while still building a sustainable and attractive and profitable business? Because we ourselves are an impact investment.
I want to talk a little bit more about Veris's mission, because I always try to get to the core motivation and purpose beyond the services you provide. So what's the deeper change that you're trying to create in the world through Veris's activities? What's the problem you're trying to solve, or theory of change? Because successful businesses that last are always solving meaningful problems. So maybe you could drill down a little more.
It's a very ambitious goal, which is, to create a more sustainable, equitable, and just world. And so, of course, there is no panacea for that. But the way we go about it is through the lens of investing. So that means furthering the mission of our clients through investing in all asset classes, but also trying to change the world through not just how we invest and who we invest with, but also a lot more around policy and shareholder engagement. We don't flip it as like, what are the core problems? We look at it as to what is our vision for the just and equitable society we want to live in. But the problems have to do with climate change being an existential threat to humanity, and economic inequality and economic inequity in terms of access to opportunity. So, and this is very well documented, of course, but, looking at the inability for African American entrepreneurs and especially African American women to get access to capital. And these are all the problems, the undercapitalized communities. A lot of our investments are around addressing that need through our managers. But shareholder engagement is also a huge factor because in public markets, that's where we feel we can have the greatest impact.
You work with both individuals, high net worth individuals, and families, as well as foundations and endowments. How do those types of relationships differ, and what unique needs does each group bring to the table?
The foundations who come to us are really interested in the full, total portfolio activation, meaning full alignment. They come to us with, well, I have a traditional advisor, the performance wasn't great, or in some cases it was okay, it was fine, but it has nothing to do with our mission. And so we're doing all this great stuff with the 5% grant making every year at a minimum. And then the endowment is unexamined for that same mission, or it's just a carve out. So they come to us to do all of the endowment in impact. They know we can do that. We have many years of experience doing this. For the families, they come to us for traditional financial planning. So that's not having to do with impact. They need optimization. They need planners. We don't just have a suite of services around just investment capabilities. We also accompany our clients through life events. We are a quarterback with their philanthropic advisors, with their accountants, with their lawyers, the trust and estate lawyers, et cetera. So there's we do a lot of traditional wealth management. It's just that the overlay is impact. And they come to us for both the investment acumen, the impact acumen, and then also the fact that we make their lives much simpler as a coordinator of a lot of their professional entourage.
How big is your team?
So we're 35 and we have 8 advisors.
And you've got a number of offices throughout America, right?
That's right. In San Francisco, in New York, Portsmouth, Denver. And then we have staff if, for whatever reason. We have one near Dallas. We have clients all over the country.
Veris focuses on 4 impact themes. One is climate solutions, another is sustainable agriculture, and then there's racial and gender equity and community wealth building. How did you arrive at these 4 themes, and what was the journey to identifying these specific areas as your focus?
Well, it's mostly client driven. I would say we have expertise in those 4 themes, but as our clients have different themes, we evolve with them. And also sometimes we pull them, we drag them with us. For example, the racial equity investing world really has become more sophisticated in the last 3 years, which is why we developed our own frameworks around diversity, equity, inclusion, and belonging. And we've, led our clients to think a little bit differently. But I would say it's mostly client driven.
You've described these themes as interconnected challenges requiring an intersectional approach. Can you bring that to life with a real example of how these themes overlap?
Basically, climate and poverty are connected. Racial justice and climate are connected. And so, for example, not everybody suffers from climate change in the same way or pollution. And so if you're investing in frontier markets or in emerging markets, the population of India and the population of East Africa or West Africa are definitely not treated equally based on level of income. And so poorer populations will be disproportionately affected because the poorer populations might be living on the coast or they're much, much more dependent on agriculture. And so issues of mass migration, food insecurity, etc., is very much at the interplay of climate and poverty and economic development. And so when you're looking at investing in agriculture, this is true also in the United States, the socioeconomic strata of farmers is lower than urban or suburban families, and they will be disproportionately affected by climate. So it's looking at what the interplay is of investing around climate solutions and who is affected. I mean, I think this is where traditional financial reporting and financial analysis, or even when I look at like traditional macroeconomic studies from any banks, I mean, there's a lot of reporting on inflation. I mean, traditionally interest rates and unemployment, just traditional metrics, but not who is impacted. The big difference is on who will be primarily impacted by inflation, who will suffer the most. When you look at unemployment figures, break it down by demographic of gender and race. And you don't see that in traditional wealth management. In our quarterly reports, we look at that, and that's really important. And so when we talk of intersectionality, so for example, you have climate on one hand and you have community wealth building on another. And then if you put them together, we would call that climate justice. And so we have a framework that Raj Pradhananga, our chief investment officer, developed around climate justice. That's the theme that is intersectional. And you're seeing more and more of that in the industry, I'd say, the intersectionality piece.
I always learn the most from specific examples. Would you be able to walk us through an example or two of investments that you have made across these thematics? And I'd be particularly interested if you could give an example of an investment that's effectively addressing racial or gender inequality. I'm just interested in the mechanics of how it works.
So Impact America Fund is a fund that is focused mostly on racial justice. And it's a venture fund that invests in African American entrepreneurs whose underlying businesses are about hiring minorities. So the fund is an impact fund, but the underlying companies could be everything from investing in beauty parlors for African American entrepreneurs who otherwise don't have access to traditional banking services or funding in poor areas, yet they are pivotal to the economic development of a certain city or region, as well as employment. That's a venture investment that where the entrepreneur Keisha Cash has been kind of a star in the space. We've invested in a company called Apis and Heritage, which is more of an ESOP model. So it's basically helping employees buy out ownership of the company for which they're employed when the CEO or the owner basically has zero succession plan. And the reason this is a racial justice play or investment is because many of those employees are minorities, so African American, BIPOC population that is rather low income, and they've never owned truly an asset. So they don't own their houses, or they're renters, but they don't own property or real assets. And what this does, this ESOP model, financing the buyout of these companies, and it could be a small construction company, it could be all sorts of companies, creates wealth with the underlying employees who otherwise would never have access to wealth. But also what it does is that it provides an asset that they can leverage for a mortgage, other financial products, and it allows the employer to have an exit, to actually, get out when they don't have a succession plan. But what it does is that it's creating wealth in communities that would otherwise not have access to capital or not have access to a financial asset. And these are transformational investments.
That's interesting. Your impact report mentioned indigenous rights investments, that caught my eye. What's the backstory on that investment and what kind of outcomes are you seeing as a result?
So we have what is called CDFIs, Community Development Finance Institutions. So basically they're loan funds. These loan funds target specific populations. So we have a CDFI called OWISTA, which is focused on Indigenous Americans who are entrepreneurs who need loans. And so that also is transformational, but it's very targeted in its approach to Indigenous Americans.
But what kind of results are you achieving with that? What kind of outcome?
That's a great question. So the two other funds I mentioned are risk-adjusted market returns. So that's the expectation. For these loan funds, it's below market. So we're looking at, a 2 to 3% a note over a 2-year period. I mean, so not commensurate with the risk. Some clients love this. Some clients don't want to touch it. So it really depends on the goals, the impact and financial goals of the client.
But what about impact on the community in terms of an outcome, not necessarily financial?
We consider those impact first investments. But the bullseye, to come back to Jed, is the blended value. I'm to you about blended value, but is having those investments where there is no counter between impact and finance. The greater the impact, the greater the financial return. And so that the Apis and Heritage case is very much a blended value one.
Social investments are often quite challenging to make a return on them in the same way that you can, let's say, in the climate and environment space, which is more crowded as a vertical. How do you approach social investments where the financial case might be more challenging, but at the same time, the impact potential is quite substantial?
Well, actually, it depends. So in Europe, we talk about social investments, and I'm thinking more of like the Ronnie Cohen language that is much more concessionary, like the pay for success bonds. That definitely is not finance first. But in our view, there is no need for the trade-off. And that's why for us, it's important to be seen and understood as excellent as an investment shop and having excellent financial acumen so that we're looking for best in class investments, both from a financial return and an impact return. And then for those clients who wish to do, more impact first, like these loan funds, to also have that offering. I mean, we're very client led, or we're in service to the client. What matters is that we meet their needs. And sometimes they do want to go to places where there is no other access. So it's expensive. These loans are very expensive to originate or to issue. And so we will have those loan funds, like I mentioned, like OWISTA or other. But generally, we don't go in with that mentality of the trade-off.
Do you find that your clients gravitate towards certain themes? And how does that financial return versus impact conversation actually play out? Are clients willing to accept different returns for different impact categories?
I mean, it depends again on the client. I think the overarching theme when we did client surveys were really climate's always the number one. It's seen as intersectional. It impacts everything. If it is not curtailed, reaching the 2 degrees Celsius increase in temperatures or more, I mean, this could have catastrophic impacts on migratory flows, on democratic stability, sovereign state. I mean, and all of that is already starting. Inflation, cost of food, famines, and you name it. So I think that is always the number one theme. But a lot of our clients, especially the families, they live off their investments. So we don't go in with that mentality of the trade-off most of the time.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.